Hello and welcome back to The Note. This week is National Ethical Investment Week here in the UK, so let's take a look at ethical investing. To say at the outset, this is a moral choice and a personal choice for people. I'm not going to make any guidance to anybody about whether it's a good or bad to invest in things like tobacco and alcohol. I merely want to take a look at whether there might actually be a good investment case for ethical investing. Now let's start by defining what we mean, and in fact ethical investing I think falls into two reasonably clear camps. First one you could call, after Hippocrates, the first do no harm group. This is the idea of screening out particular kinds of stocks that are deemed unethical, usually including tobacco, alcohol, also sometimes guns or pornography or big oil. And a second approach, which might come from Francis of Assisi, is more about doing good all the time, focusing in solely on stocks that are seen to be morally good or good for society. And at the moment that tends to mean in particular environmental stocks. Now let's start looking at this phenomenon by, we have a very useful fund in the US for comparison purposes, which is the wonderfully named Vice Fund. It only invests in tobacco, alcohol, gambling stocks, and arms. And we'll compare it with the Ave Maria Catholic Values Trust, which only invests in companies that are in line with the teachings of the Catholic Church and excludes everything that the Vice Fund has. And you can see that since the very bottom of the market back in 2009, Ave Maria is actually ahead of Vice. But if we look at the last 2 years, Vice is comfortably ahead. And then also if we look over a much longer period, going back to 2000, again, Vice seems to have beaten Ave Maria very clearly. Now, one reason for this could be that the act of screening out companies has become a mini industry of its own, and it does add to the costs of investing, which is always a big determinant of how a mutual fund's performance will look. But there's also a specific factor that has helped the Vice Fund of late, which is that sin stocks tend to be high-yielding, well-established companies, and those have been in vogue. What we're showing you here is the dividend yield on the Vice Fund, which is obviously very impressive indeed. But look at the how expensive those stocks are in terms of price to book ratio. Now this is not at all surprising. There is a lot of evidence that the popularity of high dividend yield companies has meant that people are overpaying for that yield. They're overpaying for quality. You could almost call it a high yield bubble. That means that there's a fair chance that ethical investing for the next year or two could be quite a good approach, simply because it screens out precisely those sin stocks which look, because of their yield, as though they're due to underperform for a while. And now let's move on to Francis of Assisi style do-good strategies. And here we're looking at two British funds, the Keynes Ethical Equity Fund, which is very, very rigorously screened. There's only 35% of the FTSE All-Share by market cap that it's actually allowed to invest in. And then we're also looking at the Jupiter Ecology Fund, which is one of the best known and longest established environmental funds. You'll see that both have managed to outperform over the long term, which shows that this is possible, and also that the Ecology Fund has perhaps not done quite as well as people might have thought in recent years. Now that's in line with what the indices tell us. The FTSE has a FTSE 50 and a FTSE 100 ecological index, and both of those are down quite significantly over the last 5 years. That in turn obviously could be an argument that this is now might not be such a bad time to buy ecological stocks. There are indeed a lot of investment banks pushing thematic investing based on climate change. And there are some good reasons for this. There's a much bigger universe of stocks than there used to be, meaning that it's hard to pick winners, so there might be some benefits to active management. There's a range of different sectors within ecological stocks now, which means that there's some diversification to be had there. And particularly in the case of energy efficiency, there's a possible heads I win, tails you lose arguments, because obviously in the long term there's a belief that demographic factors and climate change will drive demand for energy efficiency, but in the short term it fits in perfectly with the austerity zeitgeist. Households, governments, companies all need to cut their fuel bills if they can. So, to try to make a conclusion, and again to make clear that I'm not trying to offer moral guidance to anybody, on an investment basis, I think in the short term there is a good case to be made for first do no harm style ethical investments, because they'll exclude high yielding and perhaps overpriced sin stocks. And in the longer term, yes, there is an interesting speculative bet to be made on ecology funds.